Hello, my dear friends. I hope at least most of you, if not all of you, have been intrigued by one of the most popular IPOs of 2021, Zomato. Zomato IPO was priced at 76 rupees per share, which made a stellar debut on July 23rd as the stock opened at 116 rupees per share on National Stock Exchange with a mind-boggling 52% premium. But what made Zomato one of the highly coveted stock? Is it really worth it for long-term investment? Watch this video till the end and I promise you will have most of your questions answered. Friends, Capital Master is a SEBI-registered research analyst firm who help aspiring investors to plan their investments in an efficient manner. You can avail all our services by visiting our website. The link is given in the description box. Friends, do not forget to subscribe our channel and do not forget to hit the bell icon to get the notifications on latest videos. And if you like this video, please don't forget to like and share this video. Friends, also if you want to open your Demat account in Zerodha or Upstocks, you can open it by clicking the link given in the description box. Welcome once again. You are watching Capital Master. Friends, to understand the business of Zomato, we need to delve into the business model of Zomato and understand its growth prospects. We also need to examine its financial performance and its valuation. So let's begin. Zomato business is built on the core idea that in coming days, people in India are going out to eat at restaurants more than they cook at home. So Zomato wants to capture value of this shift in the consumer behavior. Zomato basically has three different business models. One is much renowned food delivery business, which allows customers a convenient option to search and discover local restaurants, order food and have it delivered quickly. Major chunk of the Zomato's revenue comes from the commissions charged to its restaurant partners for every order they receive from Zomato. Zomato also earns through delivery charges paid by its customers. These delivery charges are in turn used to pay their delivery partners, that is the guys who deliver the food to your home. Zomato claims that any tips paid by customers is completely transferred to its delivery partners. According to Zomato, on an average, 6.8 million customers ordered food every month on its platform in India last year. Zomato also offers dining out options for its customers, which is its second business model. Customers use dining out offerings to search and discover restaurants, read and write reviews, and view and upload photos, book a table and make payments while dining out at restaurant. Though Zomato doesn't earn any revenue in this segment, it earns a portion of its revenue through advertisements, where restaurant partners pay Zomato to improve their visibility on its platform. This improved visibility would in turn help restaurants to pull more customers. Zomato also has an exclusive membership option called Zomato Pro, which unlocks flat percentage discounts for its customers at selected restaurants across both food delivery and dining out offerings. The program allows pro restaurant partners to market themselves to a selected audience. Zomato claims to have earned around 57.5 crore rupees last fiscal year as Zomato Pro subscription charges. Zomato's third business model is based on the services which it provides only to its restaurant partners. Zomato runs another subsidiary firm called Hyperpure, through which it supplies all ingredients and other input materials to its restaurant partners in India. Zomato basically supplies high quality ingredients like spanning fruits and vegetables, groceries, dairy, poultry, meats and seafood, bakery items, gourmet and packaged foods and beverages to its restaurant partners. Zomato's revenue from Hyperpure operations was around 200 crores in last fiscal year. Friends, Zomato's business model is amazingly unique. As the saying goes, Zomato runs restaurant business but doesn't own any restaurant. It has just leveraged the opportunity with already available restaurants. But key thing to focus here is Zomato is focusing completely on food and nothing else. Unlike Zomato, though Swiggy also runs food delivery business, it has not limited its service to food industry. It's also expanding its delivery business by increasing the business scope from existing food delivery business to delivering other necessary products like groceries, medicines, electronic items, etc. But Zomato doesn't seem to have any plan of that sort in the near future, and it is clear that it is primarily focusing on food business. As far as growth prospects is concerned, India's macroeconomic factors are evidently conducive to the faster growth of food industry. For example, as per World Economic Forum estimates, India is likely to be the third largest consumer market by 2030, which would primarily be driven by the development of communication infrastructure, education, capital expenditure by government, and also increased level of job opportunities. Also, internet adoption has picked up quickly as the data rates in India have significantly declined. In 2016, with the launch of Reliance Jio, data prices became affordable at less than $1 per GB, and India's internet adoption skyrocketed from 330 million internet users in 2015 to close to 700 million users in 2020. At the same time, there has been a significant growth in adoption of smartphones driven by the availability of low-cost alternatives from local as well as global brands. Easy availability of smartphones, cheaper data, and high-speed 4G connections have enabled Indians to embrace the digital applications. According to a research report of 2019, food services market size in India was around $63 billion, which is around 4.6 lakh crore rupees. This market is expected to grow at around 9% per annum, and in 2025, this market is expected to be around $110 billion, which is around 7.7 lakh crore rupees. However, due to COVID-19, the market size has been re-estimated and slashed down to around $35 billion. The key point to be noted here is this estimation is related to the overall food industry, and in this industry, the penetration level of online food services is only 8%. Whereas in a more matured market like USA and China, we have a penetration of around 40 to 50%. So there is a huge potential in this market, provided if there is a consistent change in the consumer behavior. However, the pandemic poses a biggest threat to this industry. But if we assume that the pandemic is only temporary and we will successfully sail through, in the long run, future of online food service market looks promising, because in coming days it is expected that consumer behavior with respect to home cooked food would get shifted towards restaurant food. Now, having realized the growth prospects of Zomato, let's look at the financial performance in the past. To be frank, though the growth prospects are good, Zomato's financials are a bit baffling. Zomato hasn't turned profitable yet. It has been consistently making losses year on year. Last fiscal, they have lost around 815 crore rupees, and in 2018, they had incurred around 2,385 crore rupees loss. However, loss seems to be contracting year on year. The major chunk of Zomato's expenditure goes into advertisement and sales promotion, coupled with availability fees that they pay to their delivery partners and the salary and wages that they pay to their employees. Points to observe here is, except availability fees, rest of these expenses can be actually categorized as fixed expenses. Compared to other firms, Zomato has a higher financial leverage due to this high level of fixed expenses, because of which Zomato's break-even quantity is also high. To put it in a simple language, Zomato needs to generate higher quantity of sales to start making profit. With the current uncertainty of pandemic, majority of the customers are still wary of restaurants and online food. This apprehension of Indian consumer would be highly detrimental to the growth of firms like Zomato and Swiggy, at least in the short run. Even if we assume that things would be normal by next year end, Zomato to turn profitable within a short span needs to achieve inconceivably higher level of growth rate, which seems quite impractical. Zomato's revenue last year was around 1,990 crore rupees. With the current level of performance, Zomato needs to achieve year-on-year annual growth rate of more than 20 to 25% in order to realize positive net profits. It might take at least another 2 to 3 years for Zomato to turn profitable. In a nutshell, Zomato currently is in a very bad position. Apart from financial performance, we also need to look into the corporate governance of Zomato. Deepinder Goyal is the CEO of Zomato, who is also one of the co-founder. Gaurav Gupta, who had joined Zomato in 2015, was designated as co-founder in 2019. He was heading the supply function. However, a couple of weeks back, he has quit the firm. The critical issue here is not Gaurav exiting the company, but the firm failing to disclose his resignation to stock exchanges. As per SEBI guidelines, any appointment or resignation of such key management personnel should be disclosed as soon as reasonably possible and not later than 24 hours from the occurrence. Deepinder Goyal announced this information on Twitter even before informing the stock exchanges. This is clearly not an acceptable behavior among investors community, because this is considered as material information which can be misused to do insider trading. Adding to the above point, Zomato has also announced that they would do earnings call once in a year instead once in a quarter. Earnings call is nothing but the press conferences where investors and media will interact with the company management on the business progress. There are young small cap companies who have taken this seriously and are doing quarterly investors call, and there are certain large cap companies like Zomato who doesn't take this accountability seriously. Zomato needs to bring in a lot of transparency in its corporate governance to build confidence among investors. Adding to this, the biggest drawback of Zomato is it has negative operating cash flow and negative net profit, which makes valuation of Zomato impossible in terms of free cash flow, or in terms of price multiple. The only valuation tool which we can use is price to book value, which is around 10.2. But price to book value simply cannot be analyzed in isolation. It needs vertical comparisons like either historical data of Zomato or competitors' price to book ratio. When we have neither of these values, Zomato's valuation in the current state is simply not viable. So friends, if you ask Capital Master's opinion on Zomato, though Zomato has a strong business model, its future prospects are still unclear. Until it turns profitable, it's better to wait and watch. One important suggestion that Capital Master would like to give you is do not blindly follow the herd mentality. The constant increase in the Zomato share price doesn't really mean company is performing well. Stock price is just the collective reflection of investor sentiment. If the investor starts realizing the real risk of this business, then the price of the shares might tumble down significantly. So if at all you are planning to buy and hold Zomato for longer term, our suggestion would be to wait and watch. Once we see signs of positive net income and cash flows, we can take a clear decision. Capital Master wouldn't recommend Zomato at the current situation for long-term investment. So friends, I hope most of your questions with respect to Zomato shares has been answered. If you liked this video, I kindly request you to like and share this video among your friends and family members and help us to spread the knowledge among aspiring investors like you. Please subscribe to our channel and do not forget to hit the bell icon to get the notifications on latest videos. This is Rakesh signing off. I will be back with the latest video soon. Jai Hind.